This is John Paulamy of the Actionable Intelligence Alert. Today is March 18th, 2018. And today I'm just going to answer a few questions that came in on the YouTube channel and from emails. I mean, there's not a lot of news or anything that's really changed in a lot of the things that we've been talking about. I would say, though, that after our Jericho oil profile, the news came out last week. It was pretty good that their first well came in northern Blaine County, and it was around 950 barrels of oil equivalent. So it's one of the better wells to have come in. So that's looking good for Jericho, and the stock made some additional new highs last week. So let's get into the questions. First question came in: how do I know when to sell a stock like this, referring to uranium stocks? I'm also invested in GoVX Uranium. How do I know that the peak is reached? Because in a cycle like this, you can miss future gains going out too early and lose everything if you hope it's going to grow even more, but it's not. So this is actually a good question that not only applies to uranium stocks, but to all of these resource type stocks that we invest in, such as uranium, oil, copper, gold, whatever. As I've said before, you have to look at the cyclicality of these markets and of these stocks. They are not something you just buy and hold for 5, 10, 20 years. What we are trying to do is classic buy low, sell high. So obviously, when the news is the worst in the industry, like it is in uranium, nobody likes it, everybody hates it, it's been down for 7 years in a row now, that would be buying low. So what we're doing now is just doing the old Jesse Livermore way of thinking: sit tight, or be right and sit tight. So our analysis, I think my analysis is good. I think it's consistent with what we're seeing in the markets. Supply is contracting, demand continues to increase. You just have to sit and wait. So how will we know when it's the top? Well, I'll give you an example. During the last uranium bull market back in the last decade, around 2005 to 2007 or 8, whatever it was, when the bull market started, uranium was around $9 a pound. There were 3 publicly traded uranium companies. Cameco was one. I can't even remember the other 2. They were some international something uranium company or something like that. There was only 3 publicly traded uranium companies. No one invested in uranium. No one cared about it. There were very few plants being built. It was stagnant. And eventually, as the price went up, culminating in a top around, I think it was $140 or $150 a pound. At that point in time, over those 3 or 4 years that it took to get to $150 a pound, there were over 500 uranium companies. So I will ask you, after 20 years of being in a bear market and no one caring about uranium through the late 70s, 80s, and 90s, with only 3 publicly traded uranium companies, does anybody listening to this call actually believe that there were 500 competent uranium exploration teams out there that just popped out of the ground? No. So they have a saying in Vancouver and in Toronto. These are places where a lot of the resource stocks and companies are based, and a lot of the firms that bring them public. They have a saying about retail investors. And retail investors are most of the people listening to this video. And what they say is, when the ducks quack, feed them. So one of the ways you'll know when we're near a top of any of these resource markets is you will see this huge issuance of stock. You will see companies changing their names or changing their focus. They were looking for molybdenum, now they're a uranium company, and they're still selling the same piece of moose pasture in northern Saskatchewan. You'll see a lot of that. To really answer the question, though, you're never really going to know when the exact top is. So one of the things I advocate is these things can really take off, and I expect them to. And it's going to get really wild and woolly for some folks. They've never experienced, 100, 200, 500, 1,000% gain in a stock. So one of the things you can do to really put your mind at ease is Say, for example, this particular individual owns GoviX. Say GoviX was to double, go up 100%. Why not take down half your money? Okay. Now you've got your original investment off the table and you just let the rest of it ride. And you just keep an eye on it. And you just keep an eye on the sentiment in the market, and you stay apprised of what's going on in the market. That way your anxiety goes away, and you've captured at least your original investment, and then you could use the term you're playing with the house's money. I don't like to say that, but that's common term. Me, I'm more aggressive. I mean, I feel like, I can gauge these markets fairly well. I've got my hand or my finger on the pulse of the sentiment. So I think you'll see near a top, you'll see a lot of other things. You'll see a lot of the particular industry or discussion will increase greatly. You may even see a magazine cover on Forbes or Barron's or something like that, and that's usually a peak. When they'll say, they haven't paid attention to it for the entire time that it goes up, and then all of a sudden, when it's at $100 a pound or $150 a pound, Barron's has a front page cover about uranium. That's kind of usually a indication that you're getting to the top of a particular market. And it's just looking at sentiment. I mean, how much the stocks have moved, the valuations, the amount of paper that's coming to market with new companies. You're seeing the same thing now, like in Canada with the marijuana stocks. That became a hot thing last year, and all these mining companies were turning into marijuana companies. And the same thing about cryptocurrency. All these mining companies were changing their name and becoming cryptocurrency miners or something. So that's what you have to watch out for. That's when you'll know something's near a top. Another thing you can use that I used to really time the Bitcoin top that I darn near called right at the top was Google has a thing called Google Trends. And what it does is it's free. You can go in there, you can just look it up, Google Trends, and you can put in a keyword, like you could put in cryptocurrencies or Bitcoin, and it will show you a history. You can go back as far as you want about the trending of that search term. So you would notice that if you put in, for example, Bitcoin, you'll see that it would steadily, the interest, the amount of people searching for it online was steadily going up through 2017 and basically paralleled the price rise. And then you will notice subsequent to the end of the year last year and into this year, if you go on Google Trends and look up Bitcoin, it's dropped off substantially, the interest. So it's just like everything else. It's psychology, it's sentiment. There's these little tools that you can look at, but a lot of it is just experience. And but like I said, if you're just starting out and you happen to get on one of these big moves, which we're probably going to have in uranium here in the next year or two, there's nothing wrong with taking down your original investment. Now you just cleared off all the anxiety. You've got your money out, and you just let it ride. And that would be my advice, because that's one of the hardest things to do. It's not buying into these things; it's actually knowing when to sell out. So, if you're up 3, 4, 500% on something, and you take half your money down, I wouldn't feel bad if it doubled again. I mean, I got out of Bitcoin. I was buying Bitcoin in the 600s, the 500s. I set up my mining little operation that I had going back when it was about 500, and I sold most of my Bitcoin around $2,000, and it went up 10 times after that. Do I feel bad? No, I made 3 or 4 times the money. I just did my taxes this weekend. I'm not, I don't fret over, fear of missing out. I made 3 or 4 times my money. I thought it was overvalued. When it went up 4 or 5 times, it went up another 10 times. That's what can happen. Another thing you can do is if it doubles, sell a third. If it doubles again, sell another third. If it double, something like that, or sell 20%. There's different tactics you can use because you never know with these individual companies what's going to happen. Even in the midst of a bull market, there's going to be companies that are mismanaged and crash and burn, or they're in the wrong political environment, or in some country where some dictator, put some onerous legislation through, and the next thing you know, that stock is down 50% while the rest of the industry is up 100%. It happens. So those are just some of the tactics that I use, or what I would be looking for. And of course, you can keep listening to my podcast or subscribe to my newsletter, and I'm going to be on top of these things. Next question. Okay, so one of the readers wanted to know, you know, basically probably be a good idea if I kind of really introduce myself and my background of why anybody should be listening to me or take into consideration anything I have to say. So basically, my name's John Polemy. I know on the YouTube channel, my little name on there is Boobin2. I don't know how to change it, so I just leave it. But my name's John Polemy. You can look me up online. I've written articles on Seeking Alpha. I'm on LinkedIn. I've written articles on and posted them on LinkedIn. I have a pretty extensive internet presence. Um, I live in Texas. I work in the wind industry. I build wind farms. That's my primary job. My secondary passion, or my main passion, is investing and looking for companies and getting involved in doing research. I really love digging down and trying to find the new next thing or the thing that no one knows about. And it's really like a big interest of mine. So um, basically, I started out when I don't want to sound like a cliche, but yes, I did start investing when I was 14 or 15. I forged you couldn't set up a brokerage account back in the early 80s without your parents signing for it if you were a minor, but I did it through the mail. There was no online trading then. You had to call in your orders. And I started out trading options. I got a book on technical analysis, on point and figure technical analysis. And the worst thing that could happen for a new investor or speculator happened to me. I was extremely successful the first year that I was trading options. This was right after 83, 80, 45, around this time, about my junior, senior year in high school. And the Reagan economy was taking off, the stock market was taking off, Paul Volcker was lowering interest rates, and I was making a tremendous amount of money buying call options and making money. So of course, when you're 16 or 17, or even a lot of people when they're 20 or 30, have early success investing, they confuse luck with genius. And of course, I got arrogant and thought I actually knew what I was doing, and I had visions of sugar plums and unicorns and Skittles, and I ended up losing my whole bankroll. So that was an interesting experience. So I still didn't really know what I was doing. I would read a lot of books. One of my favorite things to read of all time was Martin Zweig. Um, he was a guy that was on Wall Street Week with Louis Rukeyser many years ago. He was one of my heroes. And I mean, I tested a bunch of different things. Basically, guys, I was hit and miss. I was lucky. I was gambling, just like I've described in other videos. I didn't have a process, a plan. I didn't have anybody mentoring me. I didn't know what the hell I was doing. So some years I would do fairly well. Sometimes I would be mediocre in my returns, and sometimes I would lose my ass. And I mean, I lost my ass in tech stocks in 2000. I did short, then turned around and got some back. And then it's just, not understanding the markets, not understanding sentiment, not understanding psychology, not having a plan, not having risk control, not understanding position sizing, all these things that I discuss now. So basically what I did was I sat down by this time the internet's going full bore, so all this information is available to you. And I said, listen to myself, I said, how do these guys that are serially successful year in and year out or over long periods of time, how are they successful? And I finally discovered that most of these guys are writing investor letters or writing about how they were successful and putting it out there for free. So I took the time to, read all of the Berkshire Hathaway letters that Warren Buffett put out. I started reading the investor letters from Howard Marks. I started, finding out who the consistently successful and profitable traders were year after year, and said to myself, I'm not going to reinvent the wheel here. I'm going to just discover what commonalities I find among these guys that are successful. And basically, Warren Buffett, Prem Watsa, these type of guys, it's all about price paid. When you buy something on the cheap, um, I, I will buy anything as long as it's cheap enough. And, that's what you're looking for. What is the value? And in order to get value, you have to be a contrarian. I've said this before. If you want to go back to the crash in 2008, you know, when the S&P was down around 660 or 666, whatever it was, you know, it's very difficult to be a contrarian there, to be in their buying, but that's what a successful long-term investor would be doing. You'd be going in at the bottom, realizing that the maximum point of pessimism, the United States is not going to dry up and blow away and go away and descend into a Mad Max scenario. That's just not going to happen, okay? It may happen in the future, but, you know, it's just not how things are set up. So being able to overcome the fear and the societal pressure that you get from the media and your friends and your family and everybody's scared, and be able to step in there and say, look, these companies are not going away. The United States is not going to dry up and blow away. I'm going to step in and buy at this really, really cheap level. And I understand when I'm doing that, that if I hold those positions, that over time, I'm going to be rewarded. I mean, I read a story about John Templeton, who ran the Templeton funds, Sir John Templeton. He was a very successful investor all the way from being a young man till he died in his 80s. And one of the things he did, I believe the story was, during the crash in 1929 that preceded the Great Depression, he had a little bit of a bankroll, and he basically went in after the stocks crashed and bought, like, I don't know, 100 shares or 10 shares or something like that of every company that traded for like under $5 or something crazy like that. And, you know, he's basically buying at the low. And he made a tremendous amount of money doing that. And, you know, we've talked about it. I'll get into it more in subsequent talks to this. You know, there's tools out there, guys, that have been back tested that work. You know, the cyclically adjusted price to earnings ratio will tell us when a market's overvalued. It's not a timing device, but it will tell us that there are undervalued markets and there are overvalued markets. And if you consistently buy overvalued markets, your returns, or stocks, your returns are going to be low. That's just that simple. And I don't, you know, and if you buy undervalued stocks or undervalued countries, your returns are going to be, you're going to beat the return, you're going to beat the averages. Now, it's not going to happen in maybe a month, 3 months, or 6 months, but as an individual investor or speculator, you shouldn't be thinking about that. You should be thinking about, you know, what can I buy that I can buy for less than $1, and just sit on it and wait until the market realizes that the story is changing from less bad, or from bad to less bad. That's the whole thing we're trying to do here. It's not rocket science. It's not even hard. And for 20 years, I wasted time, 30 years, wasted time, because I didn't understand these things. And that's why I'm trying to tell you guys. I'm trying to educate you guys on the mistakes I made. Because I'm 50 years old right now. If I would have known these things when I was 20, because I always had money investing. I always had good jobs, and I was putting money in the market. If I would have known what I've known now, I mean, I don't even know where I'd be. I'd be a lot wealthier than where I'm at right now. So these things work. These ideas work, and you just have to have patience. You know, we talked about the offshore, for example, the offshore drillers. Go back and watch that video. There's been 6 crash cycles in offshore drilling since 1982, and every single time it recovers. And when it recovers massively. And we've had the worst depression in the offshore oil industry over the last 3 years. Companies were going bankrupt. We've seen all kinds of mergers and acquisitions. And guess what? It's starting to turn around now. Oh boy, who would have thought that this commodity oil that powers civilization has to be replaced, and the people that do that are these drilling companies offshore. Okay, so they go through these common sequences or cycles of boom and bust, and you just have to identify when the bust is, step in, buy, and then just sit and be patient. It's the same thing with uranium. You know, during the last uranium bull market, I made a ton of money, and then I gave it up because I didn't use the rules. I didn't take the profits off the table. I could have made way more money than I did. And I finally learned that, you know, these things are cyclical. They're not, don't get pie in the sky. When these things start to turn, the tendency to think is start extrapolating out into the future indefinitely. You know, at some point, the oil price, or some point, the uranium price gets to a sufficient level where unlimited capital will start flowing into the market. They'll start building all kinds of rigs. They'll start running around looking for uranium all over the world. And eventually, they will cure the supply-demand imbalance. This is just how these markets work. So mastering that, understanding that, taking advantage of that, that is the key. stepping in and buying cheap markets around the world. I mean, I would not be a buyer of the FANG stocks. I would not be buying Netflix or Nvidia or Tesla or any of these stocks here in the United States. They're too expensive. When I can go buy Gazprom for 4 times earnings, it has the largest natural gas reserves in the world. It's cash flowing like crazy, and the Russian government requires it to pay out 30% of its earnings and dividends. And its subsidiary, Gazprom Neft, which is an oil company, is having like 20% reserve growth. They're all over the world doing things, and eventually, that Russian market's selling at a cape of 5, and the U.S. is selling at a cape of 30. You got to buy the undervalued. If you bought for the next 5 or 10 years, I can pretty much guarantee that you're going to do better in Russian stocks than you will in U.S. stocks. Okay, it's just how it is. The back testing shows it. Now we could have some anomaly where U.S. stocks even get more overvalued. I actually think they probably will get more overvalued, but the data is consistent over time. So one of the things that I think that's really helped me is I've traveled all over the world and lived all over the world, and I was fortunate that I've seen things and been around things that gave me an education that I don't think I could have gotten anywhere else. And I still travel today. I mean, I go all over Central Asia. I'm really fascinated with what's going on in Southeast Asia. I'll probably be writing another article about Myanmar. That's one of the last places in the world that's going to have 10%, 8 to 10% growth for the next 20 or 30 years. And you can get very wealthy if you catch some of these trends. That's a known fact. We only have to go back in time and look at what happened in Japan, post-war Japan, what's happened in Thailand, Korea, and now we have these other countries like India and Myanmar, Burma, whatever you want to call it. They're going through these same transformations. Vietnam's another one. I wrote articles on LinkedIn. You can look at about their demographics. Most of the people in Vietnam are very young, and that bodes well. Demographics are destiny. So I've been fortunate that I've been able to be in these places and see these things, and it's helped me really with my worldview. I think one of the things that happens to people in the West, especially like in the United States, Canada, not so much in the UK or in Europe because they're a little bit more, they're more traveled, I think, and more schooled up on other cultures. But people in North America, especially the United States, they really are US centric focused. And I don't really think you can be that way nowadays. You're really limiting yourself. I mean, with the internet, and we've just demonstrated it right here. There's people listening to this podcast or this video that are in other countries. I talk to people on WhatsApp or Skype or whatever from a phone in my truck when I'm driving around the job site. I mean, it's amazing. Email, all this stuff. So the ability to come in contact with people that think the same, or other investors, or people with money, or people with ideas is amazing. I've got involved in so many business deals just from people I've never even met before, physically met. And ultimately, I ended up in business with them, and it's been very profitable, and it's been very exciting. Not to mention, I mean, guys, you can pretty much go anywhere in the world on an airplane for $1,500 or $2,000. I mean, yeah, you might have to sit in economy class, but you can get to these places. And that's how I found, a perfect example is that's how I found a company in Ukraine a couple years ago that's doing farming called Agroton. I mean, this thing, Ukraine, they're having a war, but I travel there extensively because my wife is from that country. So I go there and I'm like, well, I'm in Kiev, I'm in these different cities, and I'm like, I don't really see this war thing that they're talking about. That's in eastern Ukraine. It's not really affecting the majority of the country. It's isolated to 2 provinces or oblasts. So this company that's farming isn't even in the war zone, yet the company's selling for like a PE of 0.5. It's ridiculously cheap. I mean, it's almost being given away. I mean, you have to buy companies like that. It's selling for 5. It's like buying $1 for 5 cents. I mean, if you put 10 grand into it, and it goes away, you can recover from that. But it's already up like 250% since I've owned it, and it's only still selling at like a PE of 1.5. So, I mean, these are the things that you can find if you go get on a plane or you meet people or they turn you on to different deals. I mean, I just got involved in a deal in Kyrgyzstan. So you get the, that's right, Kyrgyzstan. It's like, where is that? Okay. It's one of the Central Asian republics, Tajikistan, Uzbekistan, Kyrgyzstan. You can look it up. Small country, probably about 5 million people. But the main city, Bishkek, they have an airport there. Well, the airport authority owns the airport and it trades on the Kyrgyzstan Stock Exchange. The government owns 70% of it. They let 30% of the company free float. I mean, if you look at, now, how did I find out about this? From somebody that I know turned me on to it. Same thing. There's more and more people going to Kyrgyzstan every year. It's becoming a travel destination. More and more people going through the airport, more and more landing fees, more and more fees, more and more people, shopping and eating at the airport. Over time, as passenger traffic increases, it's basically growing at about 15 to 20% a year. It's the same thing. The thing's selling for 30 cents on the dollar. So you put 10 grand in it, 10 years later, well, you're going to have, $500,000. That's just how these things work. So I think that's, some of what I'm bringing to this conversation is a mindset, and that's looking worldwide, trying to make the world our oyster, and following all these news events and trying to uncover what's going on. A perfect example of how thinking works. So recently in South Africa, the new government there, the new president, is moving far to the left, and they've basically announced, they took a vote in their legislature, and they basically said they're going to confiscate white-owned farms with no compensation. So one of our holdings, we just sold. I just sold one of my holdings in South Africa. It was a very good performing platinum group metal operation that was doing very well. It was up about 60%. But I'm not going to stick around in a country where they're going to confiscate property with no compensation. We've seen that act before in neighboring Zimbabwe. So what's interesting, though, to note is that in neighboring Zimbabwe, they finally kicked out Robert Mugabe. They got a new government in, and they're getting rid of a lot of the laws before that were stifling investment. So you got to keep your finger on the pulse. Things are constantly changing. Things are constantly moving from good to bad and bad to good around the world. And just being U.S. focused is probably, I mean, you can do well. Like I said before, if the average investor would just put $200 a month into a low-cost index fund, $200 a month every month for 30 or 40 years, hey, you'll have a nice nest egg. But we're not trying to turn $10 into 11 here. We're trying to turn $1 into $10. So we're looking for asymmetric, big returns. And the way you get that is you got to dig down and go to places where no one else either will go or can go. And you got to remember something. A lot of these things we're getting involved with are very small. Big time operators like Warren Buffett and some of these big managers can't get involved in the things we're getting involved in. They're just too small for them. Warren Buffett has said many times that he could make 50 to 100% a year on a portfolio if he was just running like 10 or $20 million. It's easy. And I found now that through my experience, that is exactly true. And the way you do that is by being a contrarian and buying value. So one of the things I want to say here, the last thing is, even though if you're middle-aged like me, or you haven't done too well up to this point, it's not too late to start. It's not too late to change your thinking. It's not too late to have success. I like this quote. It says, the best time to plant a tree is 20 years ago, but the next best time is today. So if you haven't had good success up to this point, if your success has been up and down and you want more consistent results, I say stick around, because this is what we talk about. We talk about what's cheap, what's value, and why we think it's going to go up. So that's kind of my story. I'm just a regular guy that learned the hard way, and I'm just trying to pass it on. Am I trying to sell a newsletter? Yes, guys, I'm trying to sell a newsletter. I used to have another one, and I shut it down several years ago, but I'm starting this one back up. And I've given out a lot of good picks so far, but a lot of our picks going forward are going to be in the newsletters, which you have to pay for. So that's my motivation. I'm not going to sit here and lie. That's what I'm trying to do. But I think these, just from these videos that we make and what I write on the blog, there's a lot of good free information out there. So hope you'll continue to listen and appreciate this question. Next question, offshore oil drillers, thoughts on Ensco's acquisition of Atwood. Well, because we like the oil field, I like the offshore oil drillers. I think Ensco's best in class. They were, I think, before. It's a well-run company. Um, they have been able to weather this downturn. And I think, when you're in a depression or when your industry collapses and like the management of that company does, that will eventually recover, the thing to do is if you're a strong competitor, is to make yourself stronger. If you go back and read what Nelson or John Rockefeller did when he built up Standard Oil, I read J. Paul Getty's book about how to be rich, and he talked a lot about Rockefeller. And what Rockefeller would do is, there were in the early part of the oil industry, there was booms and busts then too. So what Rockefeller would do is he always kept a reserve of cash or the ability to have bank financing lined up so that as these booms and busts would take place in the beginning of the oil industry, he would buy up his competitors. That's why Standard Oil became almost a monopoly. They just kept buying things during any type of downturn in their particular markets that they were involved in. He would step in and have the ability to buy his competitors out. And that's what I think, with this Atwood acquisition, a lot of people didn't like it, but I look at it from this perspective. When you're in the midst of a industry depression that is eventually going to recover, you want to take the opportunity to be one of the people that's consolidating the industry, because when the industry recovers, you're going to have less players involved. And I think what Ensco is able to do, I mean, for example, I put a couple of points up here that I liked about what their acquisition of Atwood did was, in the ultra deep water drill ships, Ensco, when they bought Atwood, they went from 2 to 6 ultra deep water drill ships, which is now they own 20% of that market, and that's where your premium rates are really where you're able to charge these really premium rates. And it's one of the last areas when the industry recovers that companies will start building a drill ship. A lot of times they'll build the jackups and the semi-submersibles way before you start building drill ships. So you have to really look at, lists from the perspective of, okay, we just basically bought these assets basically cheaper than we could probably build them on our own. And the same thing with the newer semi-submersibles and jackups that they got from Atwood. It kind of high graded or lowered the age of Ensco's overall fleet. Now, a lot of people don't like the debt situation, but I'm not worried about it because they were able to move a lot of the debt out into 2022, 2024. Let's face it, guys, if this industry hasn't recovered by 2022, we won't be involved that long anyways. It'll either recover or it won't. And we're already seeing, I believe that we've already seen the bottom. We're already seeing utilization rates pick up in the rigs. So there was a lot of consternation, I believe, about maybe Ensco overpaid and the debt they were taking on to buy these assets. But I think they played it exactly right, and they bought these assets. They levered up a little bit, and they were able to buy these assets at the bottom of a depression. And I think that that's going to pay off for them as this market recovers. As you know, we think oil prices are going higher. I do. I think they're going higher. I think they're going to surprise to the high side this year. And I think that a lot of these markets are going to turn around, whether they're oil producers or the oil services companies and the offshore oil drillers. So that's my talk for this week. I appreciate the questions. Anytime you want to ask a question, either email me or put it in the comments section on the YouTube videos. I'll do my best to answer them. Like I said, guys, there's not much more to report out this week. Everything's we're just kind of sitting there in our positions and waiting for things to turn in the industries we're involved in. And that's how we're going to get our asymmetric returns. Be patient. I mean, if you don't understand why we're in offshore oil drillers or why I'm talking about uranium stocks, review the stuff on the website and do some research and reading. Understand the supply and demand dynamics. Understand the cyclicality of the oil industry and these resource markets. Look at videos by, Rick Rule. He talks about, he's a billionaire. He's been doing this for 30 years. And he's become a master of mastering the cyclicality and volatility that are inherent and consistent in these resource markets. So we'll talk to you next week. I appreciate all the support and the listeners, and we'll see you next week.